There is one thing most trading content doesn't tell you. Getting good at trading has almost nothing to do with knowing lots of complicated strategies. It's not about loading more indicators. It's not about finding more signal chart setups. It's about doing one simple strategy properly. In this video, I'm going to answer these three things. First, when you should trade. Second, when you confirm before you enter. Third, where you actually take the entry. I've been trading for 14 years straight, and I trade every single day and take 6 figures in profit every week. I can tell you with confidence that this strategy will completely change the way you trade. And at the same time, it is the simplest strategy you will ever learn. The name of this strategy is the box breakout pullback entry. You take the entry where price breaks a demand zone and pulls back to it. Today, I'm going to explain this in 3 steps. Step 1, daily candle. Step 2, 10-minute candle. And step 3, 2-minute candle. These 3 time frames and 1 Bollinger Band, that's all the tool we are going to use. We don't have to look at anything else. By the end of this video, the moment you open your chart, you will see exactly where to take the entry. When should you trade? What time zone should you trade in? This is the question I get the most from beginner traders. The answer is simple. You trade when volatility is at its highest. Stocks or futures is the same. When there's no volatility, the chart barely moves, so there's no spot to enter. So when its volatility highest, it's when the US market opens, which is 9:30 a.m. Eastern Time. If you trade a different market, use the market's opening time. Since I focus on Nasdaq, I will use the US session here. Why is this time so important? Traders from all over the world come in at the same time. That's why starting an hour before the US Open volume explodes and big moves are made. Honestly, if you fix your time and stay consistent, you can make money in any market. But for beginners, the day's trend and breakout show up most clearly in the US session. So practice taking your entries there. Today, we are going to turn the chart on 1 hour before the US Open. And we are only going to practice taking entries that show up within 2 hours of the Open. If no spot comes up, we won't trade on this day. The chart setup is simple. 1 hour before the US Open, you open TradingView and you pull up the gold daily chart. The rectangle tool is on the top left. You add this tool. Now you are going to draw a box from the daily candle's high to its low. From the highest price of today's daily candle down to the lowest price. That's step number 1. But why do we draw the box here? On top of the box is the highest average entry price of everyone who took a wrong position today. The bottom of the box is the lowest average entry price of everyone who took a short position today. Let me say simply, at the top of the box, there are people who got trapped wrong at the highest level. At the bottom of the box, there are people who got trapped short at the lowest level. That's why when price comes back to touch these levels, people make a strong reaction. At the top of the box, when price comes back up to here, they think to themselves, let me just break even. And they close their wrong position. When you close a wrong position, it means you are sending a sell order into the market. As a result, sell volume flows in and price gets pushed down again. The bounce at the bottom of the box works in the same way. At the bottom, there are people who got trapped short at the lowest level. When price comes back down here, they close their short position to break even. Along with that, the new buy volume comes in, so price goes back up. But what happens when the box gets broken? When the top of the box gets broken upward, it means buyers are willing to pay even higher than that level. That tells you the dominant side is on the buy side. You take wrong entries from here. The other way around, when the bottom of the box gets broken, It means price punched through the strongest level of buy interest. So you take short entry from here. That's step 1. Drawing one box is all there is to it. Once you've used the daily box to map out the high and the low, now in step 2, you check whether that box has actually been broken. Step 1 is drawing the blueprint. Step 2 is confirming the breakout. Because only when the box gets broken do you actually have a chance to trade. For step 2, we go to the 10-minute candle. Keep the daily box on the chart and switch to the 10-minute. But why the 10 minute? Why not the 1 hour or the 1 minute? There's an important principle here. A lower time frame is the process of building a higher time frame. What this means is, on a time frame that's too short, price can poke above the box for a moment and you can't tell whether that's a real breakout or not. Let's look at this chart. A 1-minute candle clearly broke the box and closed below it. But on the 10-minute candle, which is 10 of those 1-minute candles combined, it just had a wick and came back up inside the box. On the 1-minute, it looked like a clear breakout, but on the 10-minute, it was just a fake signal. So if you judge a breakout on a 1-minute or any time frame that's too short, you keep getting stopped out on false signals. On the other hand, if you use the 1 hour, you have to wait an entire hour for the close. While you are waiting, price has often already gone where it was going to go. The 10 minute is the middle ground. Here is where you will be able to filter out the false signals and still confirm the breakout quickly. Here is the most important rule. If a 10-minute candle closes above the box, the breakout is confirmed upward, you only take long entries. If a 10-minute candle closes below the box, the breakout is confirmed downward, you only take short entries. A break that's only with the wick has no meaning. The candle is complete at the close. If price pokes up for a moment and comes back inside, that's not a breakout. It's an attempted breakout, not a real breakout. The close has to be outside the box for it to be a real breakout. Really simple, right? When you apply this rule to the actual chart, you can see here at 2250, the 10-minute candle broke the bottom of the daily box and closed below it. Let us sum this up in step 1. We draw the box on the daily candle. In step 2, we confirm that the 10-minute candle closed outside the box. Now the direction is confirmed, but up to this point we haven't looked at a single indicator. We have judged everything with candles alone. Now in step 3 we are going to set up the entry tool to catch the exact entry point. Now we are going to move the 2-minute candle to find the entry point. The tool we use here is a Bollinger Band, but it's not a standard Bollinger Band. It's in a slightly modified setting. If you search for Bollinger Band in the TradingView indicators, the default is the same for everyone. 20-second close. What this means is the upper and lower bands are drawn 2 standard deviation above and below a 20-period average. Statistically, price has about 80% chance of regressing back inside, but when you actually backtest this, it often drops well below 80%. So we are going to change this. We are going to change the ranks from 20 to 4. The standard deviation from 2 to 4. And the source from close to open. I also changed the color to red, so it's easy to see. This is the band we are going to use to find out our entry point. There's a reason I use these 4 false values. Please check the description below to learn more about this. This 4 false Bollinger Band has a name. Since price touches 1B, we call it 1B. When a candle touches this band, we will say it's piercing the 1B. In the strategy I'm showing today, we will take our entry where a 2-minute candle pierces this 1B. Alright, now let's find the entry point. The rule is simple. Right now, the box was broken to the downside, so we only take short entries when a 2-minute candle pierces the upper 1B. The chart broke the below the box bottom, and price pulled back up slightly, and a 2-minute candle pierced the upper 1B. This is where we go short. Really simple, right? Let me clarify one thing here. The 1B doesn't have to line up perfectly with the daily box level. If the box breakout is clearly confirmed and price pulls back and pierces the 1B, that is your entry point. It doesn't matter whether the 1B is below the box or inside the box. The moment a 2-minute candle pierces the 1B, that is your entry point. Now that you've entered, you have to set your stop loss and where you will take profit. For the stop loss, most people set it at the low or the high of the candle. For a short entry, above the previous candle's high. For a long entry, below the previous candle's low. But I don't do it this way. If you set it this tight, you get stopped out by noise very often. You get stopped out by the wiggle of 1 or 2-minute candles. So what I actually use is I set my stop loss at the European session's high or the US session's high. Why? It's because those are levels that market participants have paid attention to. If that level breaks, the direction might genuinely be wrong. Looking at this chart right now, when I went short at 0.12, my stop was at the European session's high. For the take profit, try to take a multiple of your stop distance. If your stop is 10 points, aim for at least 20 points and try to take more than that. Here, my stop is 157 points, so I try to take 157, 30-14, and 40-71 points. Let me show you the result of this trade. I went short at 0.12. I set my stop loss at the European session's high, and price eventually ran up to 471 points. That's a 1 to 3 risk to reward ratio. Have you followed along? It's not difficult. Let's review quickly before moving on to real trade examples. Step 1. Go to the daily chart and draw a box from today's high to today's low. Step 2. Go to the 10-minute and check whether a candle closed outside the box. Step 3. Go to the 2-minute and when price pulls back against the breakout direction and pierces the 1B, you take the entry right there. That's the 3 steps. The gold example I just showed you did not happen because I got lucky. The same pattern repeats every time. Let me show you a few more quickly. In the US session, the box was broken upward. Price pulled back to the 1B and ran back up. Same thing here, the box was broken downward in the US session. Price pulled back to the 1B and ran in that direction. Box broken downward, 1B touch, and the downtrend continued straight from there. Same spot, same row, cut every single time. Now let me show you a different example. On this day, the box was broken upward, and the 2-minute candle pierced the lower 1B. So you took a wrong entry, but price came back inside the box. What do you do in this situation? You should take the stop loss. Let me be clear about this. A lot of people look for a 100% win rate strategy. That kind of strategy does not exist anywhere. Even with the best strategy, you have to take the stop loss when it's wrong. That's how you catch the next opportunity. Let me show you how far this strategy can run when you read it right. I pull up the gold chart and start with drawing the daily box. First, step 1, the box. 1 hour before the US Open, go to the daily candle and draw a box. From today's high to today's low. You draw it in advance. Now go to the 10-minute, keep the box on the chart. Let's watch. At 21:30, price poked the bottom of the box and came back inside, right? This doesn't count as breakout. It just had a weak and came back inside. The close was inside. Now let's wait for the next candle to close. 22.0, watch this. The 10-minute candle closed below the box. It broke through. This is a real breakout. The direction is confirmed on the short side. Now we go to the 2-minute to find the exact entry. The box was broken to the downside, so we wait for price to pull back and pierce the upper 1B. Right here, the 2-minute candle pierced the upper 1B. And if you look closely, this level also overlaps with the bottom of the daily box. A spot like this is even more powerful. Just 1B alone is one reason. But when the box level overlaps with it, you have two reasons to enter. The level market participants are watching, and the high probability of regressing is inside the band. Right here, we go short. I set my stop loss at the European sessions high of 47.98. That's a 27-point stop. For take profit, I aim for multiples of my stop. 27, 54, 81 point. Let me show you how it ended. Price kept trending down all the way to the US session close. 27-point stop, 81-point take profit. That's a 1 to 3 risk to reward. This strategy doesn't show up every day on one market. I take this trade pretty much daily, and on a single market, it usually shows up 7 to 10 times out of 20 trading days. Some days, price just chops sideways inside the box and finishes. On other days, the breakout happens but the 1B touch never comes. On some days, price runs in one direction without ever leaving the 1B, and other days, the spot only shows up right at the US session close. Then we can catch it. If you want to catch more opportunities, monitor multiple markets at the same time. If you only watch one market, opportunities are limited. But if you watch multiple markets, each one often shows a different trend. So even when there's no opportunity on any of them, a setup will show up on another. The strategy I just showed you today, the daily box, the 1B, and the pullback. These three things give you a setup you can take every day. Because we use one tool to confirm direction and a separate tool to confirm entry, the win rate is very high. But if you take a high win rate trade and close it too early, that's a mistake. To avoid getting stopped out by noise and losing your profit, you have to set your stop loss. So it only triggers when the session's major high or low actually breaks. Setting a tight stop at the highs of a few candles leads to a lot of unnecessary stop outs. It turns trading into a stressful experience. In this situation, adjust your position size based on your stop distance on each trade. When you combine other tools with this strategy, it becomes much more powerful. When a hammer candle or reversal candle shows up at a 1B touch, your entry confidence goes up a level. Not just one Bollinger Band, but when price appears and closes on two Bollinger Bands at once. That is called a precision entry. This setup works on any market. Dominance always reveals itself. Read it and write it. I will see you in the next video. Thank you for watching.